Something very unusual just happened, and almost nobody is putting the pieces together. In the last 24 hours alone, multiple developments surfaced that are forcing the market to rethink what it thought it knew about gold and silver. Prices that were falling suddenly stopped falling. In fact, gold pushed back toward the 5,000 level again, and silver quietly climbed higher after one of the most violent corrections in modern trading history. On the surface, it looks like a simple recovery. Markets go down, then they bounce. That is normal. But the timing of what just happened underneath that recovery is not normal at all. Because while prices were stabilizing, policymakers, mining companies, dealers, and the derivatives market all revealed signals that point in the same direction. Signals that suggest this recent crash may not have been the end of the move, but the reset before the next phase. And the most important part is that most people are still focused on what already happened, not what is forming right now. Let us start with the first development, because this one changes how the entire system operates. Government officials confirmed that discussions are underway to create structured pricing protections for critical minerals. Not rumors, not speculation. Official conversations between countries about ensuring stable price levels for materials considered essential to national security and industrial infrastructure. These materials include metals used in electronics, energy systems, and advanced manufacturing. Silver sits directly inside that category. To understand why this matters, you need to think about how markets normally function. Prices rise and fall based on supply and demand. When demand drops, prices fall. When supply tightens, prices rise. That balance creates volatility, but it also creates opportunity. Now imagine a situation where governments decide that allowing certain materials to fall too low in price creates a strategic risk. Because if prices fall too low, domestic production becomes unprofitable, mines shut down, supply chains weaken, dependence on foreign sources increases. That is why price stabilization mechanisms even exist, not to eliminate markets, but to protect supply chains from collapsing during extreme volatility. When governments begin discussing those mechanisms openly, it signals that the material involved is no longer viewed as just another commodity, it is viewed as infrastructure. And infrastructure is protected differently than speculative assets. This conversation did not appear randomly. It followed one of the most aggressive declines silver had seen in decades. Prices dropped rapidly, triggering panic among traders and forcing liquidations across leveraged positions. Many assumed that decline represented the end of the bullish cycle, but policy discussions emerging immediately afterward suggest that decision makers viewed those price levels differently. At the same time, mining companies released financial reports that added another layer to the story. These reports did more than show revenue and profit. They showed the actual prices miners were receiving for their production, and those prices were not identical to the prices flashing on trading screens. In some cases, miners were realizing significantly higher values through direct agreements and structured contracts. This difference matters because miners sit at the origin point of supply. They do not trade paper contracts. They produce physical metal. When their realized prices differ from exchange prices, it reveals that different segments of the market are operating under different conditions. One segment driven by financial positioning, the other driven by physical necessity. At the same time, dealers who distribute physical metals to investors and industrial users experience something that rarely happens outside major market stress. Shipping delays expanded. Inventories tightened. Customer demand surged beyond normal capacity. For a period of time, fulfillment slowed dramatically. And that slowdown did not occur because demand disappeared. It occurred because demand accelerated faster than supply chains could respond. Eventually, shipping times began returning closer to normal, but that normalization did not erase what had just happened. It confirmed that the system had been pushed beyond its usual operating limits. And when systems reach those limits, they often do not return to the exact same conditions they had before. They operate differently afterward. While all this unfolded in the physical market, something else was quietly developing inside the derivatives market. Options contracts tied to silver futures remained active and profitable even after the sharp decline. Normally, extreme price drops eliminate large portions of those contracts, but this time, many remained in place. That meant participants still had exposure to future price movements, and in some cases, the ability to demand delivery tied to those contracts. That combination created a rare alignment. Government policy discussions signaling strategic importance, mining companies reporting strong realized pricing, physical dealers experiencing supply strain, and derivatives contracts maintaining exposure despite extreme volatility. Each signal alone might not seem decisive. Together, they form a pattern, and that pattern raises a simple question. If the recent crash truly ended the bullish cycle, Why are the deepest parts of the system behaving as if the story is still unfolding? To understand that, you need to look more closely at what mining companies themselves are experiencing right now. Mining companies exist at the very beginning of the supply chain. They do not speculate on headlines. They extract metal from the ground, process it, and sell it into the global system. Their survival depends on real demand, not sentiment. And when their financial results show dramatic changes, it usually reflects something structural, not temporary. Recent earnings reports revealed something that most casual observers would miss. Revenues surged, profit margins expanded sharply, and more importantly, the prices they actually received for their silver were not always the same as the benchmark prices reported on futures exchanges. In several cases, miners reported realized prices that were significantly higher than the average market price during the same period. Think about what that implies. If the exchange price truly represented the full market reality, then miners would be receiving roughly that same price across their sales. But when realized prices exceed benchmark prices, it means buyers are willing to pay more to secure supply directly. That difference represents urgency. It represents competition. It represents demand that is not being fully satisfied through normal exchange channels. There are several reasons why buyers might go directly to producers instead of relying solely on exchanges. One reason is certainty. Futures contracts provide financial exposure, but physical supply agreements provide guaranteed delivery. Industrial manufacturers who rely on silver for electronics, solar infrastructure, and precision components cannot risk production interruptions. They need reliable access to raw material, regardless of price fluctuations. Another reason is long-term planning. Industrial users often operate on multi-year timelines. They cannot simply buy spot supply whenever prices move. They secure forward agreements to ensure stability. And when volatility increases, securing supply becomes even more important. That urgency can push realized prices above short-term market averages. Mining companies themselves appear to be responding to these conditions. Some have begun increasing exploration budgets. Others are shifting focus toward expanding silver production instead of diversifying into other metals. These decisions require long-term investment. They are not made based on short-term price swings. They are made based on expectations about future demand. At the same time, something equally revealing has been happening at the distribution level. Major precious metals dealers experienced order volumes far beyond normal levels. Customers were not only buying during price increases, they were buying during price declines as well. That behavior contradicts the assumption that falling prices always discourage demand. In this case, lower prices appeared to trigger additional buying interest rather than eliminate it. The impact of that surge was immediate. Shipping timelines extended, customer service systems became overwhelmed, product availability tightened, dealers were forced to adjust operations simply to keep up. And even after conditions began stabilizing, many dealers acknowledged that the period they had just experienced was unlike anything they had seen in years. This sequence reveals something important about market psychology. When participants believe an asset has long-term strategic value, they do not always wait for confirmation from price. They act during uncertainty. They accumulate during weakness, and those actions can create pressure that eventually feeds back into pricing. Meanwhile, futures markets continued to operate with their own internal dynamics. Options contracts tied to future silver delivery remained active. Many of these contracts were established before the crash. When prices fell, some expired worthless, as expected, but a large number remained profitable even after the decline. Options represent potential future positioning. They give participants the right, but not the obligation, to engage in transactions later when significant numbers of those contracts remain active. It means future demand has not disappeared. It has simply shifted into a different form. What makes this situation unique is the interaction between all these layers. Physical demand surged, mining profits expanded, policy discussions emerged, and financial contracts remained active. These layers are connected even if they move at different speeds. When physical demand strengthens while price weakens, it suggests divergence. When policymakers begin discussing stabilization during that divergence, it suggests concern about supply and security. And when miners and dealers confirm unusual demand patterns at the same time, it suggests the divergence is not theoretical, it is real. Markets often experience these transitional periods where the visible signal, price, appears disconnected from the underlying signals, supply and demand. Those periods rarely last forever. Eventually, alignment returns, but the path back to alignment is rarely smooth. Right now, the key question is not whether silver and gold recently declined. That already happened. The key question is why so many structural indicators began shifting immediately after that decline. Because structural shifts rarely occur without a reason, and understanding that reason is what determines where markets move next. Another piece of this puzzle sits inside the derivatives market, and it is one that most people never look at. Futures and options are not physical metal, they are financial contracts tied to expectations about future price. But those contracts still influence real-world behavior because they shape positioning, hedging, and risk exposure across the entire system. After the crash, many assumed that options tied to higher silver prices would disappear. That is usually what happens when prices fall sharply, bullish contracts expire worthless, and the market resets with lower expectations. But this time, a surprisingly large number of contracts remained active and profitable even after the decline. That tells you something important. It tells you that the crash did not eliminate all expectations of higher prices. It disrupted them, it delayed them, but it did not erase them completely. To understand why that matters, think about how these contracts function. An options contract gives the holder the right to participate in a future transaction. Some use them purely for financial gain, others use them as protection against supply risk, and in certain cases, those contracts can eventually translate into real demand for physical delivery. Most of the time, that delivery never happens. Contracts are closed before expiration, positions are settled financially, but the existence of those contracts still reflects underlying demand expectations. When a large number remain active during a period of volatility, it suggests that participants are not fully convinced the decline represents a permanent shift. At the same time, gold began showing its own response. After falling alongside silver, it started to stabilize. Buyers returned gradually, not explosively, but consistently enough to stop the downward momentum. That stabilization matters because gold and silver often move together over longer cycles. When gold finds support, it can create psychological support for silver as well. This relationship exists because both metals occupy a similar role in the financial system. They serve as stores of value, reserve assets, and industrial inputs. Their demand comes from multiple sources at once: investment demand, industrial demand, institutional demand. When those layers interact, price movements rarely follow a straight line. Another factor influencing this recovery is perception. When prices fall rapidly, fear spreads quickly. Participants assume something fundamental has changed. But when prices stabilize sooner than expected, confidence begins to return. Buyers who hesitated before begin reconsidering their position. Sellers who expected further decline begin closing exposure. This process does not happen instantly. It unfolds in stages. First comes the crash, then the stabilization, then the slow shift in sentiment, and only later does a new trend emerge. What makes the current environment unusual is how quickly structural signals appeared after the crash. Government policy discussions, mining, profit expansion, dealer supply strain, persistent derivatives positioning. These signals appeared almost simultaneously, not gradually over months, but within weeks. That timing suggests the crash may not have reflected a collapse in underlying demand. It may have reflected a sudden adjustment driven by financial positioning rather than physical supply and demand. Markets driven primarily by physical supply tend to move differently than markets driven by leverage. Physical supply moves slowly. Mines do not suddenly double production overnight. Industrial demand does not disappear instantly, but leveraged financial positions can change rapidly. Liquidations can cascade, and prices can overshoot in both directions. When leverage selling ends, price often stabilizes near levels supported by real demand. That appears to be what is happening now, not a dramatic reversal, but a gradual stabilization that aligns more closely with structural signals. The key point is that price alone does not tell the entire story. Price reflects transactions in the moment, structure reflects positioning over time, and when those two diverge, it creates uncertainty. That uncertainty is where opportunity and risk exist at the same time, because if structural demand continues strengthening while price stabilizes, it creates the conditions for upward pressure later, but if structural demand weakens, stabilization may turn into consolidation instead. Right now, structural demand indicators have not shown clear signs of weakening. Mining companies are expanding, not contracting. Dealers have experienced elevated demand, not reduced demand. Policy discussions are focusing on protection, not abandonment. These signals do not guarantee immediate price increases, but they do suggest that the crash did not erase the underlying drivers that existed before it. And that brings us to the deeper question, not whether prices crashed, but whether the conditions that drove the previous rise ever truly disappeared. To answer that, you have to step back and look at how cycles like this usually unfold. Markets rarely move in straight lines. They move in waves: expansion, correction, stabilization, and then expansion again. Each phase serves a purpose. Corrections remove excess leverage. Stabilization rebuilds confidence. Expansion reflects renewed demand. The crash that just happened removed an enormous amount of leverage positioning in a very short time. Traders who were overextended were forced out, and positions built on borrowed capital were closed. That process felt violent, but it also reset the system. It reduced the pressure created by speculation and allowed the underlying structure to reassert itself. Once that reset happens, the next phase depends on real demand, not leverage demand, real demand, the kind of demand that comes from manufacturing, infrastructure, institutional allocation, and long-term reserve planning. And the signals coming from those areas have not shown signs of collapse. If anything, they have shown persistence. Mining companies' increasing investment is not a short-term decision. Exploration budgets are planned years in advance. Production expansion requires capital, labor, and long timelines. Companies do not make those decisions unless they believe demand will justify it, and their actions suggest they see conditions that support continued relevance for silver. Dealers returning to normal shipping timelines also reveal something important. The delays were not caused by lack of interest. They were caused by overwhelming interest. When systems are pushed beyond capacity, they adapt. They increase staffing, they expand logistics, they prepare for future demand. That preparation itself reflects expectation. At the same time, futures markets continue to reflect positioning that has not disappeared. Contracts that survived the crash still exist. Participants who expected higher prices did not all exit the market. Some remained, some adjusted, some waited. That persistence indicates the narrative driving the previous rise has not been fully abandoned. Gold's stabilization adds another layer of context. Gold often acts as an anchor for sentiment in the precious metals space. When gold collapses, confidence across the entire sector weakens. But when gold stabilizes, it creates psychological support. It signals that long-term confidence in monetary metals has not disappeared. Another factor influencing this environment is global uncertainty. Inflation has not fully returned to historical norms. Interest rates remain elevated compared to previous years. Debt levels remain historically high. Currency values fluctuate as policy shifts. These conditions create an environment where demand for reserve assets does not simply vanish. Central banks, institutions, and industrial users all respond differently to uncertainty than short-term traders do. They think in terms of stability and resilience, not momentum. Their actions do not always align with short-term price movements, but over time, their positioning influences structure. This is why crashes driven by leverage often look different from declines driven by structural demand collapse. When structural demand collapses, recovery takes years. When leverage collapses, recovery can begin sooner, because the underlying demand never disappeared. Right now, what we are seeing looks more like the second scenario than the first. Leverage was removed, volatility spiked, prices fell sharply, but structural demand indicators continued operating. That does not mean volatility is over. It rarely ends immediately after a crash. Markets often test stability multiple times. Prices may rise, then fall again. Sentiment may shift back and forth, but once leverage has been cleared, structural demand becomes more visible, and that visibility begins influencing behavior. Buyers who hesitated during the crash begin returning cautiously. Sellers become less aggressive. Supply chains adjust. Production planning continues. And slowly, the system moves into its next phase. This phase is rarely obvious while it is happening. It only becomes clear in hindsight, but the signals forming now suggest the market is no longer in pure collapse mode. It is in transition. Transition between the phase that just ended and the phase that has not fully revealed itself yet. And this is where everything begins to come together. Because when you line up all of these developments side by side, a very different picture emerges than the one most headlines are showing. The crash removed leverage, but it did not eliminate demand. Mining companies reported strength, not weakness. Dealers experienced strain, not disinterest. Policymakers began discussing stability, not abandonment. And derivatives positioning remained active, not erased. That combination does not describe a market that has lost its foundation. It describes a market that has gone through a shock and is now revealing what remains underneath it. The stabilization in gold reinforces that idea. Gold did not continue collapsing endlessly. It found support, it attracted buyers, and once that stabilization began, it created space for silver to recover as well. Not instantly, not explosively, but gradually enough to signal that the decline may not have reflected permanent structural damage. Markets often behave this way after extreme volatility. The initial move captures attention, the recovery phase happens more quietly, and during that quieter phase, the most important positioning decisions are made. Decisions by institutions, producers, and long-term participants who are not reacting to headlines, but to structural conditions. Another important point is timing. Structural shifts rarely announce themselves clearly. They appear through patterns, mining expansion, dealer demand surges, policy discussions. Stabilizing prices, each of these is a signal. Alone, each signal may not seem decisive. Together, they form a trend. That trend suggests the crash may have been a moment of reset rather than a moment of finality. The key question now is whether structural demand continues, because if it does, stabilization can eventually evolve into upward pressure. If it weakens, stabilization may turn into extended consolidation. And instead, the answer will not come from one headline or one trading session. It will come from observing how these structural indicators behave over time. What makes this moment important is not just the recovery itself, it is the contradiction between what price did and what the deeper layers of the market continued doing. Price fell, but production remained strong. Price fell, but demand strained supply chains. Price fell, but policymakers began discussing protection. Those contradictions rarely exist without reason, and eventually markets resolve contradictions. They move toward alignment between price and structure. The only uncertainty is how long that alignment takes and which direction completes it. For now, what is clear is that the crash did not erase the underlying forces that brought silver and gold into focus in the first place. Those forces remain present, they remain active, and they continue shaping the environment even while price volatility dominates attention, because in the end, markets are not defined only by the moves everyone sees, they are defined by the positioning happening while everyone is still looking at what already happened. And right now, that positioning suggests the story may not be finished yet.